Every active fund promises alpha, the chance of beating the market. But what's that really worth once you factor in risk and cost? A 2025 paper by Andrew Ang and Debarshi Basu tackles this question using an old idea in economics: utility. As Andrew Ang explains, it's important for investors to ask themselves, how much is the chance of alpha worth to me?
In order to answer that, you need to go back to some old-fashioned economics and write down something that captures your preferences or behavior. And you need to go back to a utility function. And everything in finance that we have is, you don't get this for certain. There's always some risk. And because of that risk, and because of the way that these returns are correlated with each other and with macro variables and other market returns, you should be taking that into account and asking this question: how much is anything worthwhile to you?
So rather than asking, can a manager beat the market, the paper asks, how much should you be willing to pay for the chance? That takes us to another important concept in economics: willingness to pay.
If you flip a coin, how much are you willing to pay to earn $1 if something turns up heads? It would be, I think, very odd for you to pay $1 if you're only going to win that $1 with 50% probability. You would pay something less than a dollar. And that's exactly what these utility calculations, or these willingness to pay or certainty equivalents, all these jargon things mean, is that we can actually measure how much something is worth for you. The more risk averse you are, the less you're going to be willing to pay for that coin flip.
So what happens when you crunch the numbers on real-world funds? Well, Ang and Basu found that not only is outperformance rare, it's also, on average, vanishingly small. Therefore, the value investors should rationally place on the pursuit of alpha turns out to be tiny.
The amount that you should be willing to pay for alpha, it's pretty small on average. It's really under 20 basis points for that, and even lower for active fixed income funds. And that headline number itself is fairly low, 18, 20 basis points for an active equity manager. It's further lower because it's a number that's computed on funds that you would actually hold in the first place. A lot of these funds, in fact, you wouldn't even hold at all. Of these active US equity funds, we find that only about 10% of these funds are actually worth holding in the first place.
That's a startling figure. Imagine buying a product where 9 out of 10 don't work, and even the good ones only give you a sliver of extra benefit. What really matters in investing, says Andrew Ang, is your asset allocation. How much you invest in equities and how much in bonds. Fund selection is a secondary consideration, and the logical strategy is to use index funds.
If you're entirely passive and you don't hold any active funds, it's consistent with the findings of the academic literature, is that you actually will be better off than the average active manager.
So the message is simple. Decide how much risk you can live with, rebalance your portfolio from time to time, and stick to index funds. Yes, your returns will be average, but because you'll be paying far less in fees, you'll end up significantly better off over time.